Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Joel, great to see you and get your perspective as always in terms of what the heck is going on in technology, tech stocks, et cetera, as a tech trader for Wedbush Securities. So thanks so much for joining us, and do feel free to turn around and do what you need to do with the screens.
No, it's just my wife calling. I don't know.
Oh, okay. Okay, that's good. Even more important. But, you and I were chit-chatting a little bit before we started. And, we almost have to remember it's still 2021. Yep. And everything that occurred in the market year to date, we're almost forgetting about a little bit in terms of Archegos and the Reddit Finanza or whatever it is. Talk to us about, because that's what you brought up to me. And I think it's really important for us to remember where we were and where we're at.
Yeah, I mean, here we are. We're middle of October, and earnings seasons, obviously kicked off last week with the banks, and then for me, tech really starts tonight with Netflix here in the U.S. But it's been an exhausting year for many, and like you said, we had the Reddit fiasco really kind of kicked off last January, and then the next kind of big kind of black swan event was Billy Wang and the Archegos blow up, which really impacted how hedge funds are using leverage and what leverage they were able to secure. And I think that the negative fallout from the Reddit fiasco has been, just especially with the long short, hedge fund community guys haven't been able to really go have that high conviction in the short book. And typically hedge fund managers, this is where they generate their most alphas on the short side. And they're able to differentiate themselves. But with all the Reddit boards going, Wall Street Bets kind of going bananas, every other day, just, that's been a huge impact on how guys run money. It's impacted alpha generation, incredibly. And then obviously then you have the year where kind of the narrative, I think late spring, we had people were focused on the reopening, and we kind of call that big rotation into value and the cyclicals and out of growth. And obviously tech went through that period in April and May where it really underperformed the market. And then kind of once July came around, boom, you saw tech come back when Delta started to pick up more steam. And the reopenings trade's been very choppy to say the least. But I think, with that said, we're heading in the right direction in terms of vaccination numbers slowly but surely, and businesses are reopening. We are returning to more normal, but I think at a more slower pace, especially business travel. And then, kind of also throw in the middle of that when it comes to global investing, Beijing and really started the regulatory assault in early January, and it spanned from not just ride sharing to food delivery to internet platforms to video game stocks, to energy crackdown, education, online education learning, and clearly Beijing's trying to figure out how to promote growth. There's been a big push to for people to have more, increase their birth rates as well, to try to prop up growth metrics as well, which have been sluggish over the past few years. So it seems like I think their head's actually in the right place with some of the tech crackdowns. But again, that's been another wrench just kind of thrown into the entire year, which has been, it's been crazy. And it feels like right now things are actually pretty calm. Tech had a little bit of wobble in end September, early October, which that's a weaker from a seasonality point of view. Market tends to underperform in that time frame, and now here we are. I mean, if you look at some, I think Goldman has a really good historical chart going back to 1985 where it looks at seasonality, and we get a little bit of wobble here in September and October, and it's usually just up and to the right into year end. So we're on that track right now. Mm-hmm. Yeah, I mean, it's been in yields. There's still an upward bias with yields. So throw in, we'll get more kind of details on tapering and kind of policy rate hikes, which again I think the market's now telling you is that Yeah, the Fed's told us very transparently they're going to taper, but it's going to be easing monetary policy is going to happen at a very glacial pace. Nothing's going to catch anyone off guard, and hence why guys are just a lot more kind of prepared for it. And I think Bank of America had their fund manager survey out this morning. I've only glanced at it, but cash balances still are relatively high. So I think that's what we're seeing right now in the market. Just inflows back into equities and. The whole old argument, Tina, there is no alternative investment. And right now that's equities.
Yeah. Yeah. It's amazing that that's been, what we've been talking about now for years and years and years. And of course, with, the U.S. Fed policy, that being the central banker that's really driving, yields around the world, or at least the ones that we care about in terms of how it affects equity markets, that we're back looking at, continuing to invest in equities. And of course, it's always, where. And recognizing that valuations have certainly run up, which makes it maybe a little bit more challenging in terms of, really you have to be a great stock picker, I think, today and also over the past year to 2 years.
Yeah, 100%. But it's been like even, a headline hit Bloomberg yesterday and I just kind of laugh. It's kind of like Microsoft hits all-time highs. And so,
I saw that.
From an investing point of view, you can really keep it simple. You really don't need to find you don't need to go out and try to find the next Zoom. What's that stock that's going to go up 10 times? That's probably unrealistic. But now with kind of some of the lower quality junk that's been kind of pushed aside, I look at any SPAC that's come out over the past 6 months. And funny enough, I want to say in January or February, what marked the top of the SPAC boom was essentially Alex Rodriguez launching his Slam SPAC. So if you want irony, there it is. That's when the bubble officially burst.
Really? And you're a huge baseball fan too.
Not A-Rod though. Not A-Rod though.
Not A-Rod. Okay.
Everything but.
Okay. So that's why you picked that one. That was interesting.
But that obviously was like all these kind of signs of bubbles we had in the market, whether it was like again Reddit, Wall Street Bets, and in the SPAC land, those things have kind of all imploded, and you're really not seeing the appetite come back to those pockets of the market. And you're seeing money, again, as you said, it's become a very stock pickers market over the past several months. And I think like, Apple, you have a little bit of a hiccup of late at 10, I think about a 15% correction. Well, history has told us if Apple pulled back 50%, you want to be buying it. I mean, their balance sheet is still, rock solid. And it's still, another product event yesterday just kind of shows the breadth and power of the product cycle that they're currently in heading into 22. And whether or not they did cut their iPhone units by 10 million for Q4 this year, that demand's going to be there in Q1 of next year. Like no one, if you can't get an iPhone 13, say on December 1st, you're not going to go buy an Android handset. And that's kind of the beauty of them just creating the ecosystem, which is so sticky. And then obviously all the layers they've been able to add via services. So, it's been a great year. And, you're still seeing the digital transformation theme playing out within tech, cloud and security spending checks just continue to grind higher as well. And then even within the semi space, you don't need to, you can avoid the names stay exposed to the more choppy industrial automotive end markets and avoid.
Which would be, let's just remind.
Like Texas Instruments or on semiconductor NXPI. And then on memory, like kind of Western Digital, Micron, you don't need to, avoid those pockets, but stick to names that continue to work, like Advanced Micro Devices, AMD, the stock, this thing was $2 only a few short years ago. It's now north of 115. And they have probably the best CEO, one of the best CEOs in the chip space, and Lisa Su. But they've, it's a market share gain. They're continuing to gain market share at the expense of Intel, and they're well ahead in terms of leading edge technology. And that's a very simple story. Another thing like Marvell, just a play on cloud momentum and 5G build out. So, you don't need to be a rocket scientist to make money. Now, there's other things like when you want to get involved in some of these Chinese internets that have been really bombed out. That obviously takes a little bit more in-depth fundamental work, and you need timing on your side as well. But there's still some opportunities out there.
Yeah. So let's pick up on a couple things there. I think that there's probably a lot of viewers who own Apple, and when I see the stock weaken, I don't worry about it. I don't try to trade around Apple at all. But let's just kind of review, and even going back a number of months ago, I was hearing, I think it was through your morning notes, that the demand, that the chip demand was looking very strong, I thought, for Apple, correct?
Yeah, I mean, there's and the good thing about Apple as well, they are the number one, consumer of silicon content. So they are the number one customer for hundreds of chip companies. So when they need supply, they tend to get it. And that's why I think that the latest, the headlines which hit last Monday night, that they're cutting production because of some supply chain issues, and it's more of a timing issue more than anything. There's just a couple suppliers I think are having some issues. They are still going to get what they want. I think the bigger issue for Apple to keep an eye on is the Epic Apple ruling that we got back on September 10th. And if you look at tech, that's when tech really started to wobble as well. Apple specifically, Apple had done a lot of heavy lifting coming out of the summer, propping up, the NASDAQ. And so essentially now with this, now we're probably years away from any sort of implementation, but what that ruling says is that Apple needs to allow mobile app developers, they can implement their own payment systems. And so if you're playing a video game on, say, a Zynga game, you can click on a link and go through Zynga's payment process versus the Apple Store or Apple Pay, or whatever it's called. Sorry. So that could potentially impact the one big, obviously, part of the growth story on the services side, just change any impact to economics for Apple Store. So that's something to keep an eye on for the story longer term. But I think that's still being pushed out a little bit. I think guys got overly pessimistic on that.
Yeah, so let me ask you, like, from the hedge fund community, for our viewers to understand, you're an institutional technology trader. Your clients are, big hedge funds specializing in tech. So and mutual funds. So what's their view? What's the street's view? Or what's the smartest guys in the room view on that aspect of Apple or Apple overall?
Well, guys got it wrong initially. So the ruling came out on September 10th, and everyone just started buying all the big mobile plays that were going to benefit from these change in economics, right? Because essentially they would no longer have to pay that 30% fee to Apple for transactions within their apps. But then as the weekend kind of digested, people read more about it. It's going to be a longer process. A, they had to implement it, and two, like if you are playing a game on your iPhone, and would you rather just click a button right there and whatever you want to upgrade, a weapon or whatever? I don't play games, so I don't. Yeah, but I know there's obviously gazillions of people who do. Do you want to just pay through Apple, which obviously it's a lot easier, or do you want to click on another link that takes you to another site and you have to leave the game? So it's still not that, and it's so like names like Match.com but the dating apps are a potential big winner from this. But again, it feels like this is years away from being a real thing. I think on that trend, you want to look at a stock like Unity. So the ticker there is U. I haven't actually talked about it, I feel like in a little bit while. So Unity essentially builds apps. They work with developers, and they can actually implement these monetization tools.
Okay. You take.
So sorry.
You good? That's okay.
Yep, all good.
Okay.
So that's kind of, what. So with that, your initial question, do institutional investors care? They do, but right now, no.
Okay.
So that's they put it back on the back burner. Again, like they shrugged off the supply chain issues for Apple because it's not a demand, it's a timing issue, it's not demand destruction that's being seen. That would be a lot bigger worry for people.
Got it. And so, we talked a little bit about maybe avoiding some of the at-home names. I mean, they haven't been acting very well, the Zooms and the Pelotons of the world. What's the latest there?
Yeah, I mean, I think, God, I mean, it's going to be interesting. That's what I'm looking forward to most the next few weeks. Last earnings season back in July and early August, you had one pandemic winner after another come out and confess. I mean, they're struggling from, fading tailwinds, difficult growth comps, and it's really that simple. And they don't, and the growth they're seeing slowing or no growth. And so a name like Zoom, where it's obviously probably arguably one of the best stories in the market over the past, not 18 months, sorry, back in 2020. Well, now, their daily active user daily active users and download data peaked last September. Education was a big tailwind for that story. So that obviously was moderating significantly, and a bigger problem for a company like Zoom pre-pandemic, only about, I think 20% of their customers were small businesses. That number's now crept up to 40%, meaning the churn's going to be very elevated. It's going to be very hard to predict, which again is going to impact the multiple people are willing to pay for it. If you have a key growth metric that you just can't really predict with any sort of accuracy, you're just not going to warrant that type of multiple. And so that's been some of the, and then on top of for Zoom, Microsoft continues to ramp up their efforts with their Teams product. And it's funny. I think the CEO of Slack not that long ago, he said that his number one goal was essentially to kill Zoom. So that's. So competition's deep, coming from deep-pocketed, opponents, and then a name like Peloton, they've had supply chain issues. They've already announced, pricing cuts because they want to go after a lower kind of demographic, and that kind of screams that they're facing severe issues on the demand front, right? Like, if you buy a bike last year, when's the next time you need to buy another bike? 5 years, maybe, if not even, you'd hope even longer than that. And obviously banking on the subscription services, but demand, people want to do other stuff, right? They don't want to sit in their home gym or their garage and ride on a bicycle with kids screaming, 20 feet away, whatever it may be. So that's to me hard. And even on the hardware side, video game stocks have really flatlined in 2021. People haven't made any money off those stocks. Again, I think that's why the past 6 months, in my opinion, have been great. Because you could look at the Zooms, the Pelotons, some of the video game stocks. Yeah, like a normal person, we're moving out of COVID, we're returning to normal. These companies that greatly these stocks should not work, and people should be looking for other opportunities that are going to see better growth, growth tailwinds, at least in the near term. So, the gaming headsets, whether it's Logitech, Corsair. So you're really seeing, a lot of e-commerce names have kind of showed signs of slowdown as well. So I think it's been you want to avoid those type of stocks for at least another 1 or 2 quarters.
And I wonder why only 1 or 2 quarters. It seems as though, a lot of these valuations have been high. So, depending on what actually happens with COVID, if there's COVID 4.0 or whatever it is going to be, hopefully not, maybe they come back in favor, but the valuations are still stretched on most of them, aren't they? Yeah,
exactly. They're not cheap. And especially if growth is heading in the wrong direction, no one see decelerating growth. And so we still probably have another 1 or 2 quarters of difficult growth, growth comps for a lot of these companies. Okay.
And it's interesting as well, when you kind of talk about those names in that fashion, it's almost these are your words, but you said that the market is actually making more sense right now.
Yeah, I think so. And I was talking to a large mutual fund client of mine today, and looking at some of the data from the prime brokerage. So like I think it was maybe Goldman or one of the big boys, and the FANG stocks are actually, they're relative underweight versus the benchmark for a lot of these big funds. So that's why like I said, you see that headline, Microsoft all-time highs. Facebook has been a big laggard for right reasons, right? We know their platforms are toxic. We know Zuckerberg. We hope it all goes away. But with that said, like, then you have a Facebook executive coming out saying their holiday season's already fully booked in terms of advertising. Demand is huge. So they're still a beneficiary of the huge hockey stick recovery in digital advertising. And its stock has become cheap as chips. I mean, I think versus Alphabet, it's the cheapest it's been since its IPO.
Really?
2011 or 12 or so. I think 2012, I think, is when they came out. Yeah. So it's, wow. You're seeing Alphabet the past 2 days is starting to outperform, and I'd be looking to buy that name now and into the earnings, because I don't think they're not going to disappoint.
Google or Facebook?
Oh, Facebook rather. Facebook.
Buy Facebook into their earnings?
I mean, I'd be buying them all to some degree. Netflix probably scares me the most amongst the large cap growth names, just because of what the stock has done over the past 6 weeks or so. I think the move's been justified for various reasons, but I think the FANG just positioning it, nothing really feels extremely overweight. Tech isn't dangerously crowded. We've been there before, where you see wobble, and usually you can point to positioning where everyone's back all in, and that tends to obviously lead to pretty nasty unwinds in the near term. But yeah, right now positioning feels pretty clean, especially with some of these larger stories where there's still probably you can generate some alpha in a year end in a Facebook. I think Alphabet still has room to go. It's been the big year to day outperformer in the group.
After having been an underperformer.
Yeah, exactly. But now they have not just obviously search is firing on all cylinders, digital advertising. YouTube is probably one of the best short video platforms out there, and they really focus on ramping up their cloud business this year. Late last year, they finally they started to give us more and more metrics in terms of their cloud business. So that allows the both buy and sell side to apply valuations to the different components of the business. And you're like, oh, this stock's actually was cheap coming into this year, hence the 70% move or so.
Yeah. But so it's interesting though, because when we take a look at the FANG names that have, floundered a little bit over the past number of months versus the rest of the market, and in part because of somewhat of a taper tantrum or rates, US 10-year yield moving higher, compressing valuations for the tech stocks. Now that's kind of like leveled out a little bit here. You did see an unwind from the big money managers. And, you have to think about the FANG stocks and wonder if that's not the most obvious place to invest between now, October, the whatever it is, 19th or so, and year end.
Yeah, it's going to be, it's, and for all your viewers to aware, it's going to be an interesting year end. I think, I don't know the date, so I apologize, but I believe at some point in November, we should get a lot more color from Powell. I think whenever the meeting is in November, that's where we're going to get more color on the timeline for tapering. And that's obviously going to be huge. And then, government funding set to expire on December 4th. So that's something to keep an eye on as well. And then, possible action on a reconciliation bill coming out of DC as well. And then we may have a Joe Biden, Xi virtual summit that is, I think slated for at some point in December as well. So, that's the kind of things that are people's radar. So the back half, not back half, God, the last 6 weeks of the year, with it not being an election year, could be very interesting with some fireworks. So, if something were to change, whatever I say today, throw it out the window, because it could be a pretty volatile year end versus your historical standards.
I don't know, but I don't know that I would expect too much negative reaction to any of those items you mentioned, because we've seen all of them before, essentially, other than Biden or Xi.
I'm just a monkey trader, and I'm aware of them, right? So what are the smart guys running money? That's where Jerome Powell's just been an absolute rock star. His transparency.
Yeah.
There was some struggles back. I think I was on your show in December 2018, and I want to say December 20th, and I think December 24th marked the bottom. And there was this. They were starting to raise rates a little bit too quickly than people wanted, and then obviously since then he's been a deer in the headlights, scared of his own shadow. And I think that's obviously working in the market's favor. So you're probably right in the sense. But if we do get volatility in the year end, you do know why. There are some big kind of events on the calendar, but you're right. Everyone's fully aware of them. So, and that's the thing about this market, it tends to price in things well ahead of time.
Yeah. So if we think that there's some opportunity in some of the tech stocks, Facebook's cheap, AMD's got one of the best CEOs, according to you. Netflix is also a great long idea, but the stock has run pretty far. Yep. But you still like it, right?
I think Netflix, here's a stock they actually missed on their guidance back in July, and the stock kind of wobbled a little bit, and then it bottomed, I want to say early to mid-August, and people really just kind of then turning kind of the robust second half slate. So, there's just so much content on their pipeline. They've obviously had the huge hit out of nowhere with Squid Game, but to me, I look at things like Seinfeld coming to the platform October 1st. That's going to help. That's going to keep the churn low, which is obviously a big concern amongst, big talking point. More of the bears, right? That churn's going to be elevated with all these different platforms, but people aren't going to be just dropping and adding Netflix at will. It is the gold factor right now to have on within your subscription service. But then you have. They have another Witcher series coming out, Ozark, I think season 4. Stranger Things is coming out with a season 4 this year. We're getting, a new Narcos is coming out. Narcos Mexico is coming out in December. I'm drawing a blank, but there's another big series coming out in November, December of this year as well. So I mean, they're having a lot of success with their non-English programming. I mentioned Squid Game, but then they had Money Heist came out recently as well. So. And then I think if you listen to some of their competitors when they're at the Goldman conference just about a month ago, the Goldman Communicopia, you had Disney talking down their streaming sub ads. Comcast was talking down their Peacock ads, but not Netflix. Oh. So I think it's very telling that the other platforms are facing a lot more disruption, elevated churn than Netflix is. And I think that just kind of speaks to their library and their kind of their ability to kind of continue to pump out content. And now that they've been focusing on non-English programs and content for years now, and that's a lot less cheaper to produce as well. So now when they implement in the US, I mean, everyone's heard by now, like Squid Game, I think only cost them $21 million.
Wow. I just started last night.
Oh, I've heard mixed things. I'm not quite there yet, but I'm eventually I'll get around to it.
Yeah.
Now they're putting on a value of somewhere 900 million is what the article put a value for Netflix at. I mean, who knows where they came up with that number, but even if it's half of that for the $21 million price tag, it's staggering. So
yeah,
that gives them more ammo to kind of continue to generate and produce and kind of acquire more content to kind of continue to feed the machine. So Netflix is a story, I think. And then also they're making a big push into gaming as well. They bought a small studio about a month and a half ago. Now, no studio you've ever heard of, but I think it just shows that they want to stay as relevant as possible to Gen Z, to generate Gen Zers, and that, from the gaming front.
Joel, do we ever really hear from Netflix's CEO? Like when I think back, of all the television interviews, some of the US players that I watch, I don't really ever see him on a lot. What do we know?
That's a good point. I mean, it's funny. It's been a while. He doesn't really make CFO kind of gains a lot. You don't hear from Reed Hastings all that often. But I know what he's been aware of now for years. When Fortnite really took off, the video game Fortnite back in 2018, he said flat out, our number one competition is Fortnite. He didn't mention Disney. He didn't mention any of the cable, HBO. He said Fortnite. And so that's why I think it's interesting where, okay, they finally made an acquisition in the gaming side of things. And slowly but surely they can kind of start to build their content and library on that front as well. And just, another part of the story that, ability to raise pricing. So it supports the pricing power and kind of just continues to boost kind of engagement and user metrics.
Where's the valuation on Netflix versus historical? I mean, I'm sure you don't have the numbers exactly right in front of you, but just like, where are we?
It's not great. I don't have it in front of me, so I wouldn't even want to spin something and be wrong. And I'm not that. Okay. I don't want to throw anything off. It's not crazy though at all. It's it's kind of in line with some of the other the Disneys of the world, and it's nothing stratospheric.
Speaking of which, Disney did get a downgrade yesterday. Concerns on their streaming platform. You just mentioned it briefly as it relates to the digital ads that they're decreasing their expectations for. Is that correct?
Yeah, I think Barclays had the downgrade, and a few other guys were kind of. I know Disney when they did speak at the Goldman conference, they kind of they talked down their stream. I mean, so again, this downgrade could have probably been made a month ago. But they're talking down. They're running into production issues, and that was a big part of the Disney story coming into 2021. I think at an event that they held last December, they really highlighted their pipeline of Star Wars content that was coming in Marvel series as well. So that's probably going to be pushed out a little bit. Their movie slate's been pushed out. Black Panther, all of the new Marvel stories. The Indiana Jones movie, I think, is not until 2023 now. So they just announced they're pushing out the entire movie slate as well. So that's obviously just pushing the can down the story. I think longer term Disney's fine. If you have young kids, I mean, it's fantastic.
And also, of course, and the parks, the reopening of the parks and the cruise lines, et cetera, at some point, that's a lot of tailwind for sure. But let me just ask as well, as we kind of just have maybe 5 minutes left or so in terms of other ideas. We talked briefly about China and Chinese tech. I personally own some and I've stayed with it. I'm not trading that either. So you're the trader. But what do we think about, you can even own just the ETF KWEB, you can own Tencent, you can own Alibaba. What's the feeling and sentiment around some of those names?
I mean, right now, because buying an ETF is probably probably one of the more intelligent things to do. You're obviously, then you're not kind of, at the mercy of a single headline coming out and just kneecapping your company. I mean, granted, they could come out and just chop off an whole industry, what they were doing over the course of the summer. So KWEB's a way to play the Chinese internets, but, we've talked Tencent, God, I think for years, and that, it does trade on, it's a pink sheet, TCEHY. The stocks are cheap. Alibaba's screening is very cheap. And I think you look at Alibaba from a technical point of view, it held 150 like a champ. And we saw, guys, really long only money starting to dip back, put money to work back in some of these names that have been so beaten up. So Alibaba, I think right now is trading on 170, 175-ish. And it feels like an upgrade, and this thing's north of $200. I mean, this thing was $300 before the IPO debacle last November. Baidu. There were some headlines yesterday that Tencent and ByteDance are going to have to open up their content to the search engines, which benefits Baidu, who's the Google of China, essentially. So that stock looks very interesting. And they're obviously doing a lot of things in the EV front as well. And so those are probably my three favorite would be Baidu, Alibaba, and then Tencent. Tencent's obviously, they're huge on the platform side of things with WeChat. And then they're just a global behemoth in terms of video games. And they've announced a bunch of more acquisitions this year and on the gaming front as well. But those are, to me, probably the three most interesting stories that come to mind. Again,
yeah, go ahead.
If you're going to put XYZ, like just to say, 50 grand towards, Chinese internet, going a third on those three names, that's probably a smarter strategy, at least in term to see where we are in the regulatory cycle. To me, it feels like we're in the top or bottom of the eighth inning. And I think if you look at the recent data, I think Beijing's starting to realize, growth is being negatively impacted by some of these policies. I think they had to do it. And honestly, I wish that, US would come out and start kind of cracking down on some of these social media platforms. But yeah, they're trying to promote their growth, trying to promote birth rates. That's kind of their motivation, and kind of obviously, the Communist Party, right? Get in line or get out. So,
when you say crack down on the social media platforms, do you mean the ruling of limiting time for children on social media platforms? Is that what you're referring to?
Exactly. So and especially like video games, I think kids can now under the age of 18 can play 3 hours to total a week, Friday, Saturday, and Sunday. That's not a terrible thing, right? Get outside, maybe throw a ball around, kick a soccer.
I know. But it's so interesting when this came out, and I heard various anchors and commentators on television talk about this, and you can hear both sides. Like, one is that, how can you tell me, government, how to parent my children? But at the same time, too, I don't have kids, but I certainly wouldn't want them on a video game all day long because it's easier for me, Get outside. In the old days, your parents pushed you outside, even if it's raining, if you're screaming or whatever, and locked the door, and you found something to do that wasn't just staring at a screen. We didn't have them then, but, so you can see why a government really wants kids to be better than sitting in a chair all day.
I mean, you may know, how much money did Jeff Bezos make last year? 90 billion.
I think probably 90 billion. I
mean, that's sort of insane. That's not sort of, that is insane. Like, the guy can literally lose $89 billion and not change his behavior at all. I mean, that's how crazy. And I think they're aware of the wealth inequality gap, widening. And that's why they're cracking down on some of the gig economy companies. Didi came and listed in the US, and they're like, all right, we're going to shut you down. They don't want them to do that. And like, say, the food delivery companies, there's one called Metian, maybe saying that wrong. They want to crack down how much, they're lower their fees, which again, it's good for the consumer. Does the guy at the top, do the guys with all the stock at the top get squeezed? Do Western investors get crucified? Yes. But, clearly Beijing doesn't care about it. They're like, it's the goal in mind, How can they help maybe the lower people? And maybe they're probably not that idealistic, but giving them way too much credit.
Yeah. And I look, and I don't want to give credit or believe that a government should tell anybody what to do, in the sense that, like, do you really believe that government knows better than you? No, not at all. Not at all. To be very, very clear.
I used Uber 3 weeks ago, I think, and I was going somewhere from in Toronto, from say Summerhill to Yorkville, and Uber was $29.
Wow.
And I did Lyft, and it was $11. So so they're trying to get rid of just some of the price gouging. Again, if that came here, no one would really complain. But so anyway, China tech, I think we're in the late innings of the regulatory cycle, and I think
meaning the issues surrounding the stock. Okay.
Yes, exactly. And these are still really good companies that have built up fantastic businesses over the years, and again, they become a lot more attractive from a valuation point of view. And you're seeing the momentum. And I think you look at KWEB as a good way to play it. You just want a broad ETF, and you can use the recent lows as your stop loss. And and if you want a little bit tighter if you want, and if you want, and be like, what, I'm going to ride this out for 50%. And my stop loss will be 7%. I do that trade any day of the week. Take those odds any day of the week.
Okay. And speaking of Jeff Bezos, what's the latest with Amazon? It's a stock I've never bought. Shockingly in some ways, because I actually covered it when I worked at William Blair. Yeah. We picked it up in 1997, and we compared. It was Borders.com, BarnesandNoble.com, and Amazon.com, and it was only books at that time. Nobody would even probably know that anymore. Didn't buy it. Can't believe it. But now, it's kind of just sat here a little bit lately.
Yeah, it's been choppy. And I think that goes to what I was saying earlier. Amazon was a big winner of the pandemic. And obviously those tailwinds have faded. And obviously with Bezos now kind of slipping somewhat in the background, and Jassy's now there, it's funny, there's been times where Amazon stocks has worked on some of their investment plans. They're going to announce a ton of hires. They're going to continue to ramp up their cloud business. They clearly are focused on growth, but that's, I think, the story with Amazon in the near term is still margin headwinds from some of their investments. And then kind of just, I think just coming out of pandemic, just some slow decelerating trends and just kind of difficult growth comps in the near term. And the stock's been, as you said, been choppy as can be. And you've been better off putting your money elsewhere, that's for sure.
But I wonder if it's not a good opportunity now.
I don't know. I prefer Alphabet, Facebook, and the large cap growth names.
Okay.
Because I think Google's going to become a bigger player in cloud, and you just wonder how that may how Amazon AWS will react to that, and will that impact part of the growth story there, in terms of just not profit, but then on the margin side of things. So that's kind of what I'm thinking there.
Yeah, I hear you. And just lastly here, you like the long idea of Opendoor.
Yeah.
What's the there?
It's a SPAC. It was formerly a SPAC, which has been, that whole space, anything tied to a SPAC's been an absolute dumpster fire for months now, and rightfully so. But I think this is one of the better ones that has come out of it. And so essentially it's just, disruptive real estate tech company, iBuying, and they've just they're trying to change and disrupt the entire home buying process. So they obviously, they buy homes, they fix them up on their own, and then they flip them, and they obviously costs are a lot lower. So we're still in the early stages of this. So there's obviously a massive TAM. Estimates are still very conservative for a growth stock. And they're still expecting EBITDA profitability in Q3 for the first time. So it's just one of these kind of, you're looking for disruptive names. Look at Carvana, what they've done to the auto industry. So people kind of look at this as kind of a Carvana, but in the real estate market. And interestingly enough, Zillow came out with a headline Sunday that they're going to pause their home buying initiatives. So it's pretty much Opendoor, Redfin, and Zillow in the whole iBuying kind of theme. And so Zillow's pausing it. They're having a ton of issues, securing, contractors and labor, et cetera, to do all the repairs and get these homes ready to flip. But meanwhile, Opendoor is double the size and they're having no issues.
Why is that though? That doesn't make sense.
Just comes from, it's just from an execution, management's obviously just a lot more adept. at handling. So I guess we'll find out the next earnings call.
Yeah.
They could be spinning a web, but essentially it just seems like Zillow, they're just not very competent at the whole process. And this is the second time they've had to pause some of their buying initiatives to get their pipeline and backlog of properties in order. So it's an interesting space. It's like, again, it's sort of like a Carvana and what that company, and now that the rise of obviously used autos, obviously accelerated by COVID and the supply chain shortages, but very interesting companies disrupting the industry, and Opendoor is looking to do that, I think, with the real estate market.
Okay. And Joel, we're going to wrap it up in just 1 second, because I want to let you get back to the trading day. But Netflix are going to be reporting after the close today.
Yeah.
Anything of note, really, for the quarter?
No, I mean, there's like the stocks had about a 25% rally off its recent lows. So there's a long bias to it, but surprisingly, in my conversations, guys it's not a well over-owned name. And the key is going to be the guidance. So the quarter is going to be fine. I think most are thinking 3.5 to 4 million subs for the quarter will be fine. Guide is going to be key. That's where the bar has been steadily rising over the past couple of weeks. Most want to see at least 8 million guide for the next quarter. Now, so if you see anything below it, the stock's not going to work. So whether or not depending on how you're positioned in the name right now,
8 million guide for the next quarter.
8 million additions, for Q4.
Okay.
Total net adds of 8 million for Q4. So that seems to be the line in the sand in terms of where the buy side's expectations are. But again, I think if you're looking at what all their competitors have been saying over the past 6 weeks or so, everyone's seeing these elevated, churns or lowering their kind of streaming ad expectations. And Netflix, lo and behold, is the one platform that isn't, and they still have pricing power. I think with all these things that they're adding onto the service as well. So I like longer term. If it pulls back, buy it. They're not going away, and I think look for them to do bigger things in the gaming front in the years ahead, and that's what kind of could be the big driver to the multiple, 2-3 years out from now.
Okay, that sounds awesome, Joel. Amazing to see you and speak with you. Thank you, and we'll do more of this, and also on my new network that I've joined, the News Forum. So sure. Digital and linear.
Of course, I love it.
Got to do it all.
Thank you very much, and we'll talk soon.